Hey there, Dave Keller here with Market Misbehavior. Earlier in my career, I worked a lot with institutional money managers, portfolio managers, mutual fund managers, those sorts of market practitioners. And I would often, when I was trying to learn about their process, I would show them a chart and ask them, when would you feel comfortable buying this particular stock? Not that it has to do with that particular name or that particular sector, but more when you're thinking about your decision-making process. At what point does a stock start to look interesting? Are you looking for deep value, trying to buy weakness, or are you looking for emerging growth, trying to buy strength? By thinking about when you would enter into a stock, it helps you be better prepared for when you see attractive entry points coming down the road. So we're going to look here at a chart of NVDA, which has had a nice run off of the lows. It's doubled since the October low, now over about 230 here as I'm recording the video. But the question is, at what point, now that it's had this run, at what point would you feel comfortable buying the stock? And what I have found is once you've seen that a chart has actually really started to work, it's helpful to look back and think about what entry points you would have been comfortable with. And then thinking about what technical tools, what signals, what indicators would have helped you better time that entry point. Now that you see something that totally worked out with perfect foresight, can you look back, or perfect hindsight, I guess, can you look back and see and basically come up with a better game plan for the next time a similar stock has a similar attractive setup? Before we look at the chart of NVIDIA, if you like this thinking about technical analysis, the mental game of trading and investment psychology, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Which of these points do you think would have made you feel most comfortable buying this stock, and why? As we look at the chart of NVIDIA, you can see it had a pretty big downtrend from November of 2021 on an adjusted basis, peaking out in the mid 300s, then sold off, broke down through the 200-day really earlier on in 2022, but really followed through into the spring, and finally bottomed out in October around $110. On a closing basis, around $113. From there, it's rotated higher. We can see a higher low in 140 at 140 around late December. We can see a break through the 200-day moving average, and now the stock sits around 230. So if you look from the lows, the stock on a closing basis is up about 105%. So basically, you doubled your money if you bought in October and held it through today, as we're recording the video here mid-February 2023. So when you've had a stock that has had a run, one of the most important exercises I think investors can implement is having a review process, right? Looking back at your good decisions, at your bad decisions, and thinking about what you could have done better. Because the only way you improve is by evaluating some of your decisions that went well and see how you can do more of that. Look at the decisions that went poorly and see how you can do less of that. And by doing that review process, you're able to unwind the less productive habits and implement better habits to help you better identify entry and exit points. I'm going to put a bunch of lines on the chart. Don't worry about it. I'll go through one by one and show you all the pieces of evidence that I think, looking back, probably suggested to you that it may have been a good time to buy the stock. Now, the way I think of technical analysis, it's a mix of leading indicators and lagging indicators. Okay, leading indicators are things, as you could probably assume, that help you anticipate a reversal. These are indicators that help you think about trend exhaustion, right? Before the trend has reversed, what sort of early warning systems might we have? That red flag that tells you potentially we have a reversal. These orange lines illustrate, I think, one of the most important leading indicators, certainly in my toolkit, which is a bullish momentum divergence. When you have a stock that's making lower lows, often the stock will become oversold, meaning it goes below 30. When the RSI is oversold, that means the momentum is so negative, most likely you'll get a mean reversion move back to the upside. A lot of times what happens at the end of a bear market phase is you'll see a clear lower low. So if you look from September to October, the price went down a lot further, right? The bottom here was around 132. The bottom here was around 110. On a closing basis, around 113. Look at what happened with the RSI over that same period. Lower lows in price, higher lows in momentum. So oversold on the first low in September. In October, we're making a new price low, but the RSI is not. So that bullish momentum divergence indicates a likely scenario where the price is now going lower, but the momentum is actually lessening. The negative momentum is lessening. As a result, we might be at the end of the downtrend, end of the downtrend. If you look back through a lot of stocks, you'll see that bullish momentum divergence in September going into the October low. A lot of stocks bottomed in October. Some bottomed out earlier in the year, but a lot of the ones that went to a new low in October made a higher low with their RSI. That's a bullish momentum divergence. So the orange lines represent a potential leading indicator, but I know for me that it usually isn't enough to convince me to want to buy a stock because the price is still going down. And I was taught, don't buy weakness, buy strength, right? Buy when the chart is starting to turn higher. So other techniques that we are showing on this chart all will sort of line up to show you how we may have confirmed a bottom. The price went above the 50-day moving average. So maybe after the bullish momentum divergence, the price getting above moving average resistance might have convinced you, right? So the price getting above this blue line means we've been below the 50-day moving average for most of the last 12 months. All of a sudden, we rotate above there. And that could be the sign of something more meaningful. Now, what happened back here in July is you did the same thing, made a high in August, bounced off the 50-day, bounced off it again, but then failed. So if you had gotten in, maybe that would have been your stop, telling you that that wasn't actually a good breakup. We didn't get that in this case, right? Price actually moved higher, and for the next 6 weeks, we continued to make new highs. So maybe a break above the 50-day would have been enough to convince you. Maybe you're more conservative and would have waited for a higher low in December, because if you look in October, we ran up pretty quickly to the peak in early December, then we pulled back to 140. Once you spent about a week there and established a higher low, this brown line, what we call a parabola on stock charts, indicates the clear higher low. So would the higher low have convinced you, all right, maybe this is no longer a downtrend, but an uptrend because we're making higher highs and higher lows, right? So that might have been convincing with that brown line. Soon after, the relative strength actually broke to a new swing high. So you can see the trend in the relative strength was negative. All of a sudden, we broke above the trend line using the recent highs in August and December. So this is the relative performance of NVDA versus the S&P 500. Had been underperforming this whole time, now making a higher low and then breaking out. So the relative strength is actually turning higher. Does that influx of relative strength, meaning not only is the price going up, but it's outperforming its benchmark? Would that have been enough? If not, what about the inverted head and shoulders? This is a classic bottoming pattern where you have a low surrounded by two higher lows. You have the low in July, the low in December, and then in the middle you have this lower low in October. The way you basically trade that, if you're using it textbook style, is you take the neckline, which are the swing highs. If you look between the left shoulder and the head, that's the swing high there. The right shoulder and the head, here's the swing high here. You connect these two swing highs. We broke above that neckline, which basically validates an inverted head and shoulders pattern, which measures much, much higher. It actually measures back up here to 300 plus. If that didn't convince you, what about getting above the 200-day moving average? We failed to get above the 200-day in December. We finally broke above the 200-day in January. What about Fibonacci retracements, right? If you take the November 21 high, the October 22 low, 38.2% of the way up is around $199. We'll call it $200. So we got up to 200, finally broke above that first Fibonacci resistance. Finally, I would say the RSI stalled out at 40. In a bearish phase, you often find that the trend is down. The RSI becomes oversold on downtrends. When the market rallies, as it tends to do, even in a downtrend, the RSI tends to stall out around 60. It doesn't get much further than that. In a bullish phase, which arguably we're now in, when the RSI will often become overbought on the moves higher because there's an influx of upside momentum, and the RSI rarely gets below 40. So the fact that we pulled back with the RSI remaining above 40, would that have been enough? At this point, we've now had, 8 to 10 different separate technical indicators all confirming either a low is potentially coming, a low is happening, or a low confirming the low is in place. The point of this exercise is to really think about it. Now that you know, looking back, that NVIDIA was going to have a great run to the upside, look back on the chart and think about what sort of signals we saw. Was it the bullish momentum divergence in October? And again, turns out that was a perfect time to do it, but you may not be comfortable buying that kind of chart. I know I certainly am not super comfortable buying charts making new lows because I was taught that price goes down for a reason, and the market history is littered with stocks that went low and then kept going lower and continued to deteriorate, eventually literally went to zero. But if that wasn't enough for you, or if that's a little too aggressive, which one of those other indicators? Is it using one of the moving averages, making a higher low, breaking above, or breaking out of an inverted head and shoulders bottom? Was it the RSI, confirming the higher low at the RSI at 40? Was it the relative strength or the relative performance starting to rotate higher, showing that NVIDIA and semiconductors were doing pretty well? Was it the price getting above a Fibonacci level? Look back now on the chart of NVIDIA and think about which of those, where would you be most comfortable buying the stock. Then think about what technical indicators would have helped you pinpoint that particular configuration. Now looking forward, now you have sort of your idealized chart. Look for that pattern. Use screening tools, use visual analysis to try to capture similar charts in similar situations to ones that have worked before. I hope this was a helpful walk through how you can sort of do a retrospective review, looking at a trade that could have worked well and backing into the techniques and the approaches and the timing that would have helped you better enter into a stock that it turns out did very, very well since. Which of those approaches made sense to you? Where would you have been comfortable buying NVIDIA? Let me know in the comments below. By the way, don't forget to subscribe to my channel and give the video a like if you appreciate it. We'd very much appreciate that back. For Market Misbehavior, I'm Dave Keller. Be well. Talk to you soon.